Good morning. This is Mark Sturdy with 7 Days Ahead's Multi-Asset Technical Strategies, week of the 26th of October. And looking at the summary, we'll see that our interest lies in the currencies against the dollar, the strengthening of the dollar against the currencies. The FTSE, we're otherwise not excited by the stocks yet, but the FTSE is showing some patterns of interest. I think it's rather, I would just add, I think I've highlighted the FTSE as if it's aligned in all time frames. It's not. So we may be slightly over-egging it there. The bonds, we remain big bulls of yield, bearish of price in the UK gilt, and we're very bullish of oil still. Let's look at the currencies to start with, and the dollar-euro. We've got a situation here whereby the euro tried to rally in 2017-18 and failed. It tried to rally again in 2021 and failed. And the reason it's failed is the massive resistances from these prior lows back in 2005 to 2012. And the reason why we are still bearish of the euro, even having failed at this much, is because we've completed a top formation, a reversal formation here, which we think has drive the market on down further, perhaps down as far as 109, 109.50, 110. It's a double-headed head and shoulders, shoulder, head, head, shoulder, completed, slight rally back, should find resistance at this band. So we're bearish of the euro from this level onwards, and we are also bearish of the yen. Here's the big picture on the yen, the push up of the yen, it's a weakening of the yen from this bullish bull falling wedge, and another one here, both bullish, good support at 113. We think it's going to go higher. A lot weaker for the yen, a lot stronger for the dollar. Dollar sterling is weak against the dollar, but not that weak. It's the least weak of them all, and as a result, sterling euro has broken out of a trading range, medium-term trading range from April. Interesting, but in the bigger picture, it's still not extraordinary. This is the big trading range that sterling euro has been in since 2016, and it's yet to break out of that. That would require a break of 120, 121. We were, in the summary, we were interested in the FTSE. As I said, I think we're slightly over-egged this with the yellow, because we're still a bit flat to skeptical of the FTSE's chances in the long term, but no question, medium and short term, the FTSE looks good. Let's have a look at it. Long term, we still don't know whether the FTSE, it's failed twice to sustain moves above 750. It's pushing up the whole area of confusion and failure here that we're pushing into. But it has been impressive insofar as it's overcome the resistances from these lows in the medium term. And in the December contract, we have a completed bull triangle, which is exciting. Might push us up to 76.50. 76.50 is certainly the prior highs up here. So we may have a catalyst to at least revisit these prior highs. It would be bold to suggest we're definitely going to break through it, because I don't think there's enough on them underneath the market. But this is an impressive, possible impressive bullish pattern here for the FTSE. And it's in the short term we see how well it's supported for these prior highs here, allowing it to push ahead. So that's an interesting situation, if not as out and out bullish as the summary might suggest with this yellow, because we're skeptical in the long term. UK gilts are an exciting chart. We have the breakdown of the long-term drop in yields here, going back to 1989, 1990. We have the completion of a reversal pattern here, classic head and shoulders reversal pattern, which calls the market up to 1.8 in the short term, more or less that high there. The market is, in price terms, of course, falling, and this is the short-term price chart. We think this trend will continue. It's got to break, obviously, down beneath 123.44 in the short term to get the bears going again, but we think this bear trend in the short term will continue, as it will in the medium term and the long term. Long term, we think it's going to go up and test, interestingly, 1.8 is probably that high there, as I said there. Our other situation of note, we think, is the oil. The oil has broken out of its, what's a quarterly bear trend resistance. It's broken. certainly the last 2 quarters, just over. In the monthly chart, it's overcome the lows from these, the resistances from these lows where it failed before. It's broken up emphatically, and that's with a close this month to be confirmed. No, it has been confirmed, I beg your pardon. And we also have a situation in the weekly chart which may be a slightly imperfect head and shoulders reversal. We broke up 3 weeks ago above 96.90 and the neckline there. The point and the use of this for traders and investors is that should the market come down to 80, there should be great support there. So there's now great support beneath the market were it to come off. The short-term chart shows the bullishness, and we think it's set to go further. That's it. Thanks very much.